The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the webinar hosted by the Investor Responsibility Research Center Institute on a new report, Microcap Board Governance. Our agenda today is as follows: introductions of our speakers, an in-depth review of the research, the view from the IRRC Institute on the report findings, and then we'll take your questions. In terms of logistics for today's sessions, all of the attendees are in listen-only mode, but we do encourage your questions. If you have questions during the presentation, please use your chat box, your control panel, the question box, to send us your questions. After the review of the research, we'll respond to those questions. We are recording this session and a replay will be available later today, along with this PowerPoint presentation. If you're interested, we encourage you to share information about this report on social media. Our Twitter handles are right there if you'd like to share information on Twitter. And if you have any audio issues during the session, please contact GoToWebinar at 1-800-263-6317. We have two speakers today. The first is Annalisa Barrett. She is the report author and also founder and CEO of Board Governance Research and a clinical professor of finance at the University of San Diego School of Business. She has nearly 2 decades of experience in the field of corporate governance, including positions at the Corporate Library in Towers Perrin. John Lekumnik has served as Executive Director of the Investor Responsibility Research Center Institute since its founding. Along with the board of directors, he has led the organization to become a leading source of objective academic and practitioner research on an array of investment issues. He also has decades of experience. He's worked as an institutional investor, including time as the investment advisor to the New York City pension funds. And just a little bit of background about the IRRC Institute if you're not familiar with the organization. It's a nonprofit that was established in 2005, and the mission of the organization is to fund and disseminate objective research on issues of importance to investors. It's both academic and practitioner research. The IRRC Institute sponsors an annual research award with 2 $10,000 awards, and you can check on our website for more information on that. The deadline is coming soon, October 19th of this year. On the website, you'll see there are more than 75 research reports available at no charge. And you also may have seen our recent news last month that the IRRC Institute selected the John Weinberg Center for Corporate Governance at the University of Delaware as its successor organization. The Weinberg Center is will receive a grant from the IRRC Institute to materially expand its environmental, social, corporate governance, and capital market research, and it also will maintain the full library of IRRC's research at no cost. The Weinberg Center also will continue to fund and manage the annual IRRC Institute Research Award. And with that, I will turn the presentation over to Annalisa, and she will run through the report findings. Annalisa?
Thank you, Kelly, and thank you to everyone who's listening. I'm very happy to get to share with you my research on microcap board governance. I have been wanting to do research on microcap companies for many years and was so thankful to the IRC Institute for the opportunity to do so, and thankful for the opportunity today to share my research findings with you. The reason I was interested in focusing on microcap companies is because they play an important part in our economy. There are actually more microcap companies than there are larger cap companies in our capital markets, especially when we consider that over 10,000 microcap companies are traded over the counter in the over-the-counter markets, in addition to those traded on the major exchanges. This study specifically, we defined microcap as companies that have $300 million in market cap or less, and so specifically we also focused on companies that are traded on the major listing exchanges. These companies, even though they play an important part in our economy, they have not received a lot of attention in the governance conversations that are being had around the country and frankly around the world. And there are reasons for that. Specifically, microcaps are typically not included in the major indices, and therefore not included in investment holdings of index funds, for example. Many do not have an analyst following, and so investor attention, is not as focused on them. And specifically, as well, in terms of corporate governance. Practices and scrutiny on those practices, these companies have typically not been targeted by the institutional investors for engagement or shareholder proposals as well, although they are seeing an increasing amount of shareholder activism targeted at microcap companies. So for these reasons, since we don't have a lot of studies looking at the board practices, the corporate governance practices, director compensation at the smaller companies, I really wanted to explore them and find out what differences are there in microcap board governance. So before I start, I wanted to just point out that I would love to hear from all of you who are interested in microcap companies and thinking about other topics of microcap governance that might interest you, or other data points that you might be interested in. I'm, as a result of this study, building a database of microcap company governance data, and would love to hear from any of those of you who are interested in that, or have ideas for expanding that, or other studies on these topics. Next slide, please. For this study that we're talking about today, we chose approximately 10% of the 1,552 publicly traded companies in this size range that, again, are traded on the major stock exchanges, major U.S. stock exchanges. And specifically, that was done so that we could compare their practices to the larger companies, especially those that relate to the listing requirements of those major stock exchanges. The 160 companies included in this study were randomly selected from that group of 1,552. And the data that we'll be discussing, most of the data was collected by Board Governance Research, by me, and the additional data was secured from a variety of data vendors who I'm very thankful to for sharing and providing information for me: Equilar, MSCI ESG Research, for Fund Votes Research, and NASDAQ. Next slide, please. So what companies are included in this study? And again, remembering that these 160 companies do represent, all of the publicly traded companies under 300 million in market cap that are traded on the major U.S. exchanges. So they do, by studying the companies in this report, it does give us a good snapshot of what companies of this size range do look like. And so we see in this slide we get a view of the industry sectors that are represented. And as you can see, 30% of the companies are in the healthcare space. And if you drill down into that healthcare sector, over half of the companies in that healthcare sector are pharmaceutical companies, and another almost quarter of the companies in that healthcare sector are biotech companies. So perhaps not a surprise there. Another prevalent industry that shows up in this company size range is the finance companies, and 70%, so the majority of the companies in that finance category, are banks and savings institutions. So as you can see, they're not all tech startups. Technology is, a little bit over 10% of the companies involved or included in this study. But there's a good mix of different industries represented in the analysis. On the next slide, please. The report includes all sorts of other details about the companies included in the study, but I wanted to highlight the number of employees that are employed by the companies studied. In fact, if we look at the 160 companies studied here, there are about 61,000 employees represented by the companies in this study. So again, just contributing to the notion that these microcap companies do play a very important part of our economy and provide jobs to many people. Now, we may have assumed that the microcap companies are extremely small companies, and many of them are, with fewer than 10, even fewer than 50 employees. But more than half of them actually employ at least 100 people. The largest company in the study employs 4,500 people. And there are a few companies, however, included in the study that don't employ anyone directly. They rely on employees from affiliate companies or advisor firms. Next slide, please. So, as has been noted several times in the social media discussions about the report, in some cases we are busting some myths about microcaps. So we may have a perception that microcaps are all startup companies, like I said, maybe all tech startups that are led by their founders and have majority shareholders that control all the votes. And in fact, the data do not bear out those assumptions. In fact, 22% of the companies studied went public in the last 5 years, but that means that over 3/4 of them have been public for more than 5 years. So they're not newly IPO'd companies that just haven't grown past the microcap stage. They are, longstanding companies that are in that microcap category. And only 14% of the CEOs that are included in the study are founders of the company. So only 14% of these companies are led by their founders still. So they're not all, led by founders who have just started the company recently. And I was very surprised to see that there are not, there's not a preponderance of these companies that have multiple class stock structures or dual class stock or disparate voting rights, which may be a trend in new IPOs in certain industries, but does not, is not reflected by the broader group of microcap companies. Again, those which we noted have also been public for longer than 5 years as well. And only 4% of the companies have a majority shareholder. So we're not looking at controlled companies for the most part. Next slide, please. So the next several slides highlight some of the key findings from the study of the boards themselves. So looking at the composition of the microcap company boards. The first finding relates to the issue of gender diversity in the boardroom, a very hot topic and issue of much focus lately, especially here in California, where our legislature is looking at mandating gender diversity in the boardroom. So when we look at the microcap companies, the microcap boards that were studied, more than half of them have no women in the boardroom, and only 12% of them have more than one woman. And this is in stark contrast to the numbers for the Russell 3000. Again, there's a lot of focus from large institutional investors that have made this topic one of their big issues in terms of improving boardroom deliberations by having diversity sitting around the table, and specifically gender diversity being the focus of some proxy voting guidelines of the large institutional investors, where investors will vote against the directors at boards that have no women on them. So in the case of the microcap companies, there's definitely room for improvement in this area. Next slide, please. Another key finding in the board structure and board composition area is looking at the leadership structure of the boards. Whether or not the CEO is also the chair of the board. And when it comes to separation of the two roles, the microcaps are just as likely as Russell 3000s to have the CEO not be the chair of the board, or have separated the roles of CEO and chair. In both cases, 62% of both of the microcap company studied and the Russell 3000 have different people serving in the roles of CEO and board chair. However, there's a striking finding that many of the microcap companies don't have independent leadership at the board level. So if you look at the two charts on the slide, the one to the right indicates that when the roles are separated, almost a third of the companies where the roles are separated have a non-independent chair, and quite often this person is in a role of executive chair. So again, the roles are separated. The CEO is not the chair, but the person who is the chair is not independent from the company. And this slide, or the chart to the left, shows that when the roles are combined, it is common practice among larger companies here in the U.S. When the roles are combined, to have a lead director step in and lead discussions of the independent directors and play other roles that are similar to a board chair role when it is a conflict of interest for the CEO to do so. And in fact, 70% in fact of the companies where of the microcap companies where the roles of CEO and board chair are combined, they do not have a lead director. And if we go to the next slide, we can see that many of the companies in the study have actually explicitly stated in their proxy statements that that this decision to not have a lead director. So it wasn't a matter of timing or that one wasn't named at the time that the proxy was filed, but traditionally they have one. In fact, these companies have made a pointed decision to not have a lead independent director, even though they have combined the roles of CEO and chair. So I selected a few of the companies to highlight to show you some of the language that is used to describe this decision in the proxy statements. As you may know, U.S. companies have to provide a discussion regarding their board leadership structure in their proxy statements. And so in these companies that have decided to not have a lead director, they provide some explanations in that section of the proxy as to why they don't have that role filled, or why they have not designated that role. And some of them, as you see, note the small size of the company and maybe the scope of the company as a reason for not having lead independent director in place. Some indicate the fact that they have a very active actively involved group of directors, a small board most likely, that are all actively involved, and therefore there's no need for a lead independent director. But the most common reason is similar to the bottom bullet here, that says that there's no explanation given. Basically, they've determined it's not necessary to have a lead independent director at this time, but don't provide further discussion or insight into that decision making. Next slide, please. When we look at the size of the microcap boards, you might not be surprised to learn that they are smaller than the Russell 3000 boards, and in general, board size does follow along with company size. So this finding may not be surprising, but it was notable that that there are almost a quarter of the microcap companies have fewer than 6 directors. So which is a very very unusual practice among Russell 3000 companies. So so we have relatively small boards leading these microcap companies. In fact, there are 10% of the microcap companies have only 4 directors. And so with a board with only 4 directors, if you think about the composition of that board, almost always the CEO of the company is on the board. So that leaves only 3 spots open for independent directors. And so that also requires, in most cases, all 3 of those directors to serve on all of the board committees. If we look at the other extreme of board size for the microcap companies, there were 18% of the companies have 9 or more directors, and most of those microcap companies with larger boards are banks. Again, in case you're not aware, banks and financial institutions quite often have larger boards than companies in other industries here in the U.S. Next slide, please. Looked at the frequency with which the microcap boards meet and compared that to those of the Russell 3000 companies. And although the overall numbers are generally similar, it is notable that there's more variability in the number of meetings. And in fact, more companies have fewer than 4 meetings, or more larger percent of the companies have fewer than 4 meetings among the microcap boards. Meaning, in fact, some companies only met 2 times during the 2016 year that was studied, as disclosed in the 2017 proxies. So a board that only meets 2 times is very unusual among the larger companies. And at the other extreme, it's also more likely for the microcap companies to meet more often, to have 12 or more meetings, which averages out to at least 1 meeting per month, which again is relatively uncommon in the U.S. for larger companies. Also in the report, there are details about committee meetings and how frequently they take place. And there are some extremes where some companies or some microcap boards, compensation or nominating and governance committees didn't meet at all during the year. So that was notable. And then an audit committee has, there are examples of audit committees only meeting once during the year, which typically, at the very least, among the larger companies, they would meet 4 times to review the quarterly earnings reports before they went out. Next slide, please. Speaking of the committees, looking at the committee structure of the boards, the microcap boards, again, as might be expected, have a less complex committee structure. So they're more likely to have only the key committees, the audit, compensation, and nominating governance committees. And those committees are present in with about the same prevalence as they are in the larger companies. But when it comes to more specialized committees, it's relatively uncommon for the microcap boards to have specialized committees focused on technology or focused on strategy. Again, this is likely due to the fact that most of the microcap boards are much smaller, and therefore, the entire board serves and addresses the issues that would be addressed by a committee among larger boards. Next slide, please. So when we looked at the director election practices of the companies studied, there were 2 findings that stood out. First of all, I might have expected, and some might expect, to see a higher prevalence of classified boards among the microcap companies, to the extent that a classified board could be used as a takeover defense. However, we don't see that to be the case. It's about the same prevalence. 46% of the microcap companies have a classified board compared to 42% at the Russell 3000 companies. And so that overall finding is not was surprising in that there was not as much of a difference as might be expected. There is a difference, though, when it comes to director election standards. So while over half now of the Russell 3000 companies have adopted a majority standard for director elections, thanks in part due to the Council of Institutional Investors campaign to urge companies to make those changes over the years, and other institutional investors, their members and others, have focused on asking companies to adopt a majority standard for director elections. The microcap companies have largely not made that change and are still following the default standard of a plurality director election standard. So there may be room for engagement with the microcap companies to discuss the reasons as to why a majority standard is something that institutional investors and others are calling on companies to adopt. Next slide, please. So the next few slides will talk about the directors who are serving on the boards of the microcap companies that were studied. Who are the people who are serving on these boards? In total, there were 1,134 directors studied as a part of this analysis. And one thing to note is that as as the discussion continues around increasing diversity in the boardroom and expanding the candidate pool for director service. Um, the directors who are serving on microcap boards are experienced directors, and they could be considered and may not currently be considered as and targeted for potential directorships among the larger companies, but there's certainly an opportunity there to expand the director pool for experienced directors as companies across the capitalization spectrum are looking for new directors and diverse directors as well, and directors with different types of expertise and experience. So the directors, as you can see in the chart on this slide, the directors' ages are not all that dramatically different than the ages of the directors on the Russell 3000 boards. However, at the extremes, at the younger ages and older ages, there are some differences. So 25% of the directors of the microcap companies are 70 years or older, so in that 70 or 80s age range, and a few 90s as well. And that's compared to 20% of the Russell 3000 companies. So slightly more likely to be in that older age range. And then when we look at the younger age range, younger than 50, we see that microcap companies are more likely to have directors in that younger age range as well. In fact, when we look at an even younger cut of the data and look at directors who are under 40 years old, we see that the microcap companies, 3% of the microcap directors are less than 40 years old, and only 1% of the Russell 3000 directors are under 40 years old. So again, younger directors are present in a higher percentage there as well. Next slide, please. We also, of course, looked at the gender. So when we look at the entire pool of 1,134 directors serving on the microcap company board studied, only 8% of them are female. And so the numbers are 16% among the Russell 3000. Again, this is looking at 2017 proxies. If we look at the newest year, it's up a little bit more at the Russell 3000, but still, a woman, microcap director is half as likely as a Russell 3000 director to be female. Next slide, please. So in looking at the people who are serving as the CEOs of the microcaps, the gender diversity of the CEOs is very similar to the gender diversity, or I suppose I should say lack of gender diversity among Russell 3000 CEOs. So we have 96% of the microcap CEOs are male compared to 95% of the Russell 3000 CEOs who are male. So I think that that speaks for itself in terms of a lack of female CEO leadership in all companies across the size ranges. The ages of the microcap CEOs, again, are somewhat similar to those of the Russell 3000 companies in somewhat of a surprising finding in that, again, we might have an assumption that the CEOs or that the microcap companies are being led by young CEOs who are founders who have these small companies, when in fact, these are mature companies led by, senior people who have been in their careers for many decades and have similar ages to those of the Russell 3000 companies. Next slide, thank you. So the last two slides for the kind of recap of the findings of the study feature the data on board compensation. And so we see that the total amount spent, including cash and equity values, total amount spent on the board is significantly less at the microcap companies compared to the larger companies. So, even at the median, the total board compensation is, 3 times more at the Russell 3000 companies than it is at the microcap companies. Of course, some of that is dictated by the fact that there are fewer directors on most of the microcap company boards, in addition to lower fees paid. And on the next slide, we'll see the result of the lower fees paid to the individual directors. This slide shows the average individual director for each board. And looking at the microcap companies, you can see that in general, a director of a microcap company board will make about a little bit less than half of the amount that a Russell 3000 director might make. And again, this is including cash compensation and equity compensation. So with that, I will hand it over to John McCumnick for his thoughts from the IRC Institute perspective.
Thanks very much. And I do want to just take 20 seconds for an institutional prerogative. As Kelly said in the beginning of this, we have announced that the Weinberg Center at the University of Delaware will be the recipient of all of our intellectual property beginning next year. It has been my pleasure for 10 years to lead the IRC Institute. One of the really fun things is to get to work with great researchers like Annalisa. And so it's been fun working with her on this project and looking at microcap companies. End of institutional prerogative and onto a viewpoint. As Annalisa documented, there are important differences between microcap companies and larger public companies. I think the question really for investors is why? Is it appropriate that the corporate governance is designed to fit, it's bespoke to the companies, or is it just that corporate governance reforms, which have been fairly well documented to add value or to, at a minimum, reduce risk, haven't worked their way down the capitalization table yet? Next slide, and I think the answer is it's a little of both. Certainly, just intuitively, smaller side, less complexity plausibly explains the simpler committee structure. The variability in board and committee meeting frequency, there's just quite honestly not as much oversight needed. It's easier to get a handle on. But when something goes wrong, there also isn't as much institutional resource within a company, and so the board is called upon to play a larger role. And so you have variability in the board and committee meeting frequency, and a lower board and individual director compensation is, direct result of size. So that leaves what it doesn't seem to explain. And it would not seem to explain the lack of gender diversity. There is no study that I know of that suggests that gender diversity is less important for smaller companies than for larger companies. The lack of a lead independent director. And I just want to point out one thing when you go back and look at these slides later. It's not just that 30% of the combined chair CEOs companies have no lead independent director. There's another group of companies that have a non-independent chair. When you add all that up, 51 of the 160 research companies have no independent leadership on the board. So if there is a situation where there are directors who think the CEO needs to be changed or that there's a strategic change in direction, there is no logical rallying point or place to say, is it just me or do you also think this? So nearly 32%, almost a third of the companies have no independent leadership. That's an interesting finding that I do not think size explains. And the prevalence of plurality voting, that is clearly just a reform that has not made it down the cap system yet. Plurality voting was the de facto voting standard as little as a decade ago for large cap companies. It has changed on a company-by-company basis. This is not a regulatory change, and it has generally changed when institutional investors have engaged or put a proxy resolution forward to change it. Given the cost of that engagement and the cost of a proxy resolution, it is not surprising that it hasn't worked its way down the cap chain yet. But with an increasing number of microcap institutional mandates and specialties, I would imagine we will see that coming fairly quickly to the microcap sector. The last slide, please. So that is the prediction. Change is coming. I don't think most people who have been practitioners in the field believe that one governance size fits anyone. In fact, one size governance fits no one. And there are some things that are maybe, quote, standard, end quote, for larger companies that need not happen at microcap companies that are needlessly complex, needlessly expensive. And so you can simplify those standards to better suit a microcap situation. On the other hand, as Annalisa mentioned, and as I just said, governance reforms often work their way down the market capitalization table, and so some things will change, and some of the microcap practices do appear to be just bad legacies, like the lack of gender diversity and the lack of independent board leadership. And so I think it is a safe bet to say that those will become less prevalent over time as the governance reforms at larger cap companies just become part of the context of public company governance in the United States. And with that, we'd love to hear from you and get your questions. So I'll turn it back to Kelly.
Thanks, everyone. So we're on to the Q&A portion of the webinar. As a reminder, if you have questions, use your control panel. There's a question box. Just type your question in. I'll read it out loud, and either John and or Annalisa will respond. It looks like we have several in the queue. This is a good one for Annalisa. Do you have any data comparing profitability?
I did not do that portion of the analysis to look at the performance of the companies. So no, I do not have that. Certainly it's something that could be pulled together, but I don't have it available.
Okay, thank you. The next question.
I guess one thing.
Oh, sure.
I'm so sorry. One thing I could add though is I have noted just anecdotally that several of the companies that were included in this study are no longer, they were selected a year ago and are no longer around. So they've either gone bankrupt or have been acquired. So I suppose we can draw some conclusions about at least the ones that have gone bankrupt or otherwise had to be delisted or had other challenges.
Okay. The next question, I can take this one. Will the PowerPoint slides be available? Yes, they will be. After this webinar, we'll post an audio replay of this session as well as the PowerPoint slides. So you can just go to www.irrc Institute. You can click on the home page to the report, and all the supplemental materials will be posted there as well. The next question is on the topic of gender diversity. In lack of gender diversity, you published in terms of the numbers of directors. However, if a company with 4 directors has 1 female director, they are at 25% diversity, higher than most Russell companies. Do you have a breakdown in terms of percentage of female directors versus male counterparts?
I do have that. I do have that in the database, yes. I don't think that it got included in the report, but I do have that information. So I'd be happy to share that with someone or anyone who would be interested.
Okay. Thank you.
I would also, however, just note that on an absolute percentage basis, the number of female directors as a percentage of the 160 sample companies is half that of the Russell 3. So I don't think that whoever asked the question is correct as to the math, but I don't think that is the typical situation, given that we're capturing both the numerator and the denominator in both of those situations where we're looking at total percentage
Okay. The next question, what was your most surprising finding in this report?
I'm sorry, you cut out just a minute. What the most surprising finding?
Yes, sorry.
Yes. So many of the surprising findings I talked about, but I would say that um, I was surprised to see several of the boards that met so infrequently, and several of the committees that met so infrequently, given the level of responsibility and the level of work that has to be done at the board level. And I was also surprised to see one-person committees. Several times there were boards that had designated maybe had a nominating governance committee or a compensation committee that had only one member. That was quite surprising to me. I also saw some, I think, to John's point about legacy practices that are still present in these smaller companies that have largely gone away at larger companies. I did see anecdotally, didn't quantify statistically, but I found some companies that are still providing healthcare to their directors or otherwise providing them other perks. And those have largely gone away among larger company director pay packages. So that was surprising to me as well.
Great. Just checking. It looks like that's all the questions we have. So I'll give it just another oh, wait, we do have one more. I was particularly interested in your observations about audit committee meetings. Did you happen to see any evidence of implications of the minimal participation
Mm.
of audit committees?
Yeah, it's a great question, and I didn't look at it in that way, but that would definitely be, a path for further research to dig deeper into those companies where the audit committees either had very few members and or met very few times to see if there were any, if there was any correlation to, accounting practice problems or lack of, problems to indicate any lack of oversight of either the accounting financial reporting functions or risk management in general, internal controls. So that would definitely be a good idea for further study.
And here's a follow-up question to that one. I would also wonder about overboarding among microcaps. Do you have any comments on that?
Hmm. Yes, in fact, so that data we did collect and compare to the Russell 3000, and in fact, the didn't put it in the slides, but the microcap directors are much more likely to serve only on one board, as opposed to compared to the Russell 3000 directors, where there are more who are serving simultaneously on several boards. I don't have it in front of me, the exact numbers. Oh, here it is. So yeah, 83% of the microcap company directors do not serve on any other boards currently. It doesn't mean that they haven't ever served on another board, but they're not currently serving on another board. And that's compared to 65% of the Russell 3000. So 83% for the microcap company directors, 65% for the Russell 3000 directors. And again, that only captures, as is required in the proxy disclosure rules, only captures the publicly traded company boards that they're serving on. It doesn't capture private boards, pre-IPO boards, and other, nonprofit boards.
Okay, several more questions have come in. What is the average level of independence of the board as a whole?
So this is a good question, and is actually listed in the report on, let's see, on page 28 in the full report. And so there is a discrepancy here. Now, first, I should start with a caveat that the level of independence that is used and disclosed in the report is the independence determination that's made by the company, made by the board itself in determining whether or not a director is independent. So I should say that to start out with, these are independence designations that are made by the company. I did actually do a second level of independence assessment based on kind of a more proprietary approach to evaluating independence, which is more a higher level of scrutiny for determining independence. But that's not included in the report. It's a bit subjective. So, but nonetheless, when we look at the company's independence assessment, the most notable finding is that for the most part, we see that, let's see if I add these all up.
I have the numbers.
About three. Oh, go ahead. Go ahead, John.
So 32% of the microcap companies have less than 70% independent boards.
Yeah.
That compares to only 26% of the Russell 3. Additionally, you're much more likely to have a virtually totally independent board, 90 to 100% of the Russell 3, versus microcap. Microcap levels of independence at that level are only 3% of the company boards, and it's 13% of the Russell 3. That being said, there is a majority. Anyway, it is in the chart, which, by the way, is available free of charge at ircinstitute.org, and it's on page 28 of the report. So there's slightly less independence, but not hugely less independence overall. The leadership, though, is an interesting view.
Right. Yeah, the lack of independent leadership is striking. And also there is an analysis to designate the reason for the director's lack of independence as well. So for the most part, the reason that the microcap directors are designated as non-independent is because they're a current employee of the company, but also former employees having a transaction with a company. The typical reasons for designating someone non-independent as a director are present as well. And but having said that, I would say that there were, at least from my observation and having looked at this issue for 15 years now, a very high level of related party transactions that I feel at least seem to be more prevalent among the microcap company boards than we tend to see in the larger companies. So at least as disclosed in the proxy statements, the related party transactions that were considered for independence by the board seem to be more dramatic and more frequent among the microcap company boards.
Our next question, did you see variations in gender diversity by sector?
Yes, and I have that again in the report on page 23. You can see that looked at the percent of boards in each industry sector that has no female directors. So the industry that was most likely to have no female directors is energy and utilities, in addition to the industrials and transportation. The finance companies had the lowest prevalence of all male boards or boards with no female directors.
The next question, did you look at minorities on boards?
Unfortunately, no. I would love to do that, but the disclosure requirements that are in place do not require companies to provide that information, and so for this study, I was limited to the publicly available information from proxy statements and company websites. I would love to do that.
Oh, sorry. Do you believe that it is reasonable for governance-minded investors to hold microcap companies to similar or same standards of governance as larger cap companies?
I'll take that one. I think it goes to what we said earlier, which is asking why something is different. So, I don't think you need the same number of I don't think you need the same number of directors. You probably don't even need the same level of meetings. But I don't know that there's anything related to capitalization size that says that all male boards do better, or that no lead independent director in a combined chair CEO situation is a good governance practice. So I think that the question, the answer, if you're asking overall, the answer is no. Of course, they're not going to have the same standards, and they probably shouldn't. But there are certain standards, majority voting, that there is no rational reason for a microcap company not to have the same governance standard.
Yeah, I would definitely agree that the same standards being expected doesn't make sense. But I also would agree that the investors have just as much of a right to engage with and question the governance practices at microcap companies as they do at other companies. To the extent that they're owners in the company, they have that right to, to engage and to ask for more information and understand why governance practices and board composition and other practices are in place.
Okay, just a couple more questions we have in the queue. What externalities do you see that could accelerate improvements to these baseline practices?
I actually think this report is one of them. Sunlight is the best disinfectant. The level of attention that microcap governance has gotten in the couple of weeks since this report has come out has been extraordinary. So that's one thing, and the second is engagement from investors. These are no one goes out to say I'm going to start a company or I'm going to be the CEO of an existing company and I'm not going to have good governance, right? I mean, it's just we haven't thought about it. We're small, we're busy running our company day to day, and you saw that, for instance, with majority voting. It's very difficult with a straight face to say that, oh no, of course we shouldn't have majority voting, we should have plurality voting. And so once the question gets raised, things change. And so in some ways it's engagement and sunlight, and this report is designed to provide some of the sunlight and certainly a starting point for engagement for institutional investors.
Next question, is the average tenure of the directors very different in the micro companies compared to those in the Russell?
It is not, surprisingly. It is actually very similar. Again, in the report on page 26, there's a chart that compares it, and the numbers are not notably different. There's slightly less percent of the directors of the microcap companies have been on the board less than 3 years. But otherwise, there are not significant differences in the overall tenure, which was surprising as well. Again, and that goes to, it follows along with the notion that, not only are these not new companies, but that the directors are experienced directors that have been on the board for some time.
The next question, did you observe a different prevalence of disclosed related party transactions with directors among microcaps?
I did, and unfortunately, it's difficult to quantify and compare to Russell 3000 companies, but definitely based on my experience of looking at Russell 3000 companies for many years, I definitely saw a higher prevalence of related party transactions, as well as some more egregious or concerning related party transactions still in place, where again, maybe at the larger companies, the additional scrutiny from investors and analysts have led companies to move away from accepting those related party transactions. They may still be in existence at the microcap company level, maybe because they make sense for the companies, but also maybe because they haven't been, identified and scrutinized by external observers. And I will say there were, I had several instances in looking at the company, spending a lot of time in the proxies and getting to know each of the companies. And several of these companies that fell into the category of, a group of people who are community leaders in a city where the company is headquartered and have a lot of transactions amongst all of each other, also serving on the board together. It certainly happens at the larger company level as well, but was notable among the microcap company boards setting.
Terrific. Well, that concludes the Q&A portion. We thank everyone for your insightful questions, and we also thank everyone for your time. As a reminder, this PowerPoint presentation and a replay of the webinar will be posted later today on www.irrcinstitute.org. If you have any additional questions, just feel free to reach out to us, to either John or Annalisa. You can see here is their contact information, phone, and email. We can also, any questions you have, feel free to send them to us on social media as well. So on behalf of the IRC Institute and Board Governance Research, we thank you for your participation today and hope you have a good rest of your day. Thank you.